us their view on the market. Rakesh, great having you. Let me start off by what you're doing in a market like this, Rakesh. There's so much sector churn. One day you've got IT buzzing, the next day you've got banks and IT is in the red, and then third day you've got both of them in the red and a completely new sector emerging. How should one look at the tilt?
Yeah, hi, good afternoon, and thanks for having me on the show.
Good afternoon.
So you're right. Sectorally, we are seeing quite a lot of churn, but I think fundamentally where we are putting more money across is where we believe that over next 3 to 6 months and maybe even longer, from 1 to 2 year perspective, we continue to see very strong earning trajectory, and therefore some of the financial services plays which are more into NBFCs and small banks, consumer discretionary as a space, auto ancillary as a segment. So these are the names where we have been far more positive on, and we continue to remain reasonably more positively biased towards those.
Financials, I believe Rakesh is a consensus trade, so I'll touch upon that later. Let's talk about auto ank. We've seen a decent run up, especially post the GST rationalization. Um, uh, what in what segment now would you start to place bets at this juncture from a risk reward standpoint?
So I think across various direct OEMs, if you think of it, there are opportunities in the four-wheel space, also in the farm equipment plays largely, where we believe that the concerns related to deficient monsoon and early low seems to have been far more priced into the stock price already. But what we are also seeing is very strong traction on the four-wheel passenger vehicle segment. And also, when you look at the numbers and when we have spoken to companies, it comes out very clearly that companies have been able to mitigate a lot of this raw material price inflation through price adjustment in last 3 month odd period. And now that we have seen RM prices stabilizing and moderating from here on, the margin profile for these companies can actually see reasonable uptick compared to what we have seen in recent past, and therefore this gives them a very large operating leverage play also, with stronger volume growth and better margins coming through, gives you a much higher traction on earnings. Also on the auto ancillary space, if you see lot of companies which started as pure play auto segment plays have now diversified into various other segments. We have a company in our portfolio called Sansera Engineering. It's not a recommendation, but I'm just highlighting as to where we are actually thinking of these plays largely coming into diversifying beyond auto ancillaries into aerospace defense segment, where the opportunity for global supply chain remains very, very high for quality Indian manufacturer. And that's a theme that we still continue to like.
I want to question you a little bit more on that. This aerospace theme, the multiples being given to some of these companies are obviously extremely elevated. How should one look at scale in this business? Because it's a slightly more gradual business, but it's a more consistent business, if I can call it that. Um, and give us a sense, therefore, how to look at it structurally as a story. Because how much of the future earnings are actually borrowed in today's valuations is what I'm trying to assess and judge. And how do you pick, therefore, the right value at the right kind of time and price?
Sure, no, very fair question, Ars, and I think you have asked a question that we continue to deliberate on every day, to be honest. As you also rightly indicated, I think the entry barriers to this particular business is very high. And when you look at the overall opportunity, and I'm just talking of the commercial aerospace segment today, where the two large players have very large order book already in play, right? But they are struggling for adequate supply chain. Backward integration and things like that, and therefore the supplies are constrained. They are in dire need to look at quality suppliers, and which is where I think some of these Indian companies are actually very well placed. And when you look at these companies, for example, some of the companies that I just talked about, right? They are growing maybe 50 to 100% on revenue growth trajectory, and this business, especially in aerospace defense, has far higher margin profile than what you would probably have in the pure auto ancillary space, right? So you have a meaningfully higher growth with much better margin profile coming in. is the play that we will probably look at. And I think once you enter the space with the set of OEMs and the ecosystem, the opportunity to then increase your wallet share is much higher. And therefore, this opportunity for Indian manufacturing, especially in this segment, can be a very long-term story. Of course, the valuations one need to be reasonably careful of. You need not pay very high multiples. So if you are looking at, maybe companies growing at 25-30%, a PEG of maybe between 1.2 to 1.4 times still looks reasonable too.
Rakesh, very quickly trying to understand what's changed in the environment because, we're seeing more of these stories come to the fore. Is it just that these stories were largely not spoken about and now suddenly there's conversation, or has something changed on ground structurally from a business standpoint that we're getting more recognition and more orders from this segment?
No, I think a large part of it is actually more environment driven, and what we have seen in last few years where Indian companies have entered the ecosystem of the supply chain, right? And therefore, some of them were initially very small players, and they've been able to prove their capability and quality, and therefore the incremental market share or wallet share gains are meaningfully higher. And based on the confidence that some of these OEMs now have on Indian suppliers, they are actually scouting for quality plays across the board. And that's why I said, some of the plays that we are talking of actually started their business as auto ancillary plays and now migrating or diversifying into aerospace defense. And I think this opportunity is largely also backed by, as I indicated, very large order books that companies already have. And they are still struggling to find reliable supplies at reasonable price points. And this is where Indian precision engineering companies can actually play a pivotal role going forward as well.
Interesting. From the financials, Rakesh, how would you play it? Because there are just so many ways to address that. Where is it that risk reward is the most favorable at this juncture?
So I think two segments where we are more positive on, especially on the lending side, is actually the small size banks, which are probably talked about as more regional banks, are now diversifying from those specific regions to other regions as well, which is driving a reasonable amount of growth trajectory from there. So if you look at the credit growth numbers, right, we are touching 17-18% as a system wide level. So there are opportunities in some of these smaller size banks where the growth could be at least 4, 5, 6% higher than this. And that is what is going to drive the NI growth and earning trajectory as well. Also, NBFCs as a play, I think, given that there is so much of credit growth and these companies will also benefit from the large FCNRB deposit that are coming into the larger banking ecosystem, which will then get passed on to the smaller banks and NBFCs also, are the place where we think that if companies are able to deliver upwards of 20% credit growth, there seems to be a reasonable opportunity for earnings also to compound at least with that number or even higher, because we believe that NIMs probably have now bottomed out and NIM obviously have a scope to expand further from here, which will drive incremental earning growth as well. So these are the places where we are actually betting our stocks on. So a few names that we have already in the portfolio, which is a public disclosure, is City Union Bank, Tata Capital, and things like that.
Okay, so some of the smaller names. And how do you look at the AMC pack very quickly before I dive into that break?
Yeah. No, I think AMC is a structural story, and therefore, some of the large AMCs will probably continue to gain from the large SIP flows that market is continuing to see, and companies which have had very strong performance track record over a period of time, have a very strong distribution mode, will probably see them continuing to have meaningfully higher market share, at least able to retain or maybe improve from there off. The challenge in AMC also, as you know, Harsh, is that incrementally with larger AUM, the TR actually comes down, and therefore the translation of AUM into revenue growth could have some moderation. But it is also a very large operating leverage play, right? So with similar kind of operating structure, you manage a 1 lakh crore AUM and you can as well manage a 10 lakh crore AUM. And therefore, the operating leverage is something that will drive the earning over and above the risk that I highlighted. A reasonable multiple around AMCs is what we have been focusing on. We already have ICICI Pru AMCs in our portfolio. Stock has been doing well. It's also a play where there is reasonably large alternate business where at least the risk that I talked about around TR is not so prominent. And this is where their ability to mitigate that challenge on reducing TR will get addressed.
Okay. Uh, I'm going to dive into a very short break. It's a mandatory commercial. So I'll pause this conversation for just a few minutes. Welcome back, and we're joining you from the Suzlon studio here in ET now. Let me quickly take you through, of course, the auto pack, because that's the pack which seems to be doing fairly okay. Real estate is the other one, which is holding up very well for itself. So auto and real estate are the key buzzers in trade today. Let's pull up some of the constituents if we can. 0.5% higher on the Nifty Metal Index and the Defense Index as well. These are sectors which had to some extent fallen out of favor. There's a rotation at play, and you can see that evidently so. Auto, of course, on the back of those numbers of TVS and Bajaj, you're seeing a bit of a reaction to the TVS numbers more than anything else. There you go, 6% higher on TVS Motors. And given that, you're seeing a strong move. But we're in conversation with Rakesh Vyas, and we were speaking about a couple of themes. One was financials. We spoke a little bit about that, but more importantly was the auto theme and stocks going into the aerospace segment. We spoke fairly well on that. That was an interesting part of the conversation. But Rakesh, let me extend this. Try and get a sense as to what you're completely avoiding at this point of time. What likely is a consensus play which the street seems to be getting wrong, in your opinion?
No, I think if you look at the overall holdings of larger players, they have reasonable overweight on the large private banks, which is where I think we have a anti-consensus view. I think some of these banks are actually still struggling for either growth or margins. And with the size that they are now at, it becomes very difficult for them to continue to outpace the overall system credit growth. And therefore, that is a segment where we have consistently moved away from in last almost 1.5 year. And as I indicated to you, we have moved towards some of the smaller banks and NBFCs as a play. Also, I think we have been reasonably positive on the power T&D play, very different from, let's say, the renewable equipment manufacturers or the power generation plays in general, where Street has been far more positive on earlier. But I think power T&D also has become a reasonable consensus, play largely now. But I still think that there is a medium-term opportunity, not just in India but globally, for these equipment suppliers, given the kind of demand that we see on grid strengthening and data centers, etc. So this is another place where we've been positive on, and I think incrementally also Street is now tilting more towards consumer staple part of the business, where I think some opportunity to take price hike, given the raw material inflation, is what is exciting everyone. But therein, we still struggle to see these companies doing meaningfully higher volume growth, and therefore, what we talked about as operating leverage is something that we don't see coming in a material way beyond this recent price hikes that we have seen recently, and therefore, I think these are the names where we have been far more cautious on and underweight on. Also, I think it's not a consensus play right now, but large IT companies have been underweight position for us for a pretty long period of time, which is where we think that growth is still very, very meager or moderate. And therefore, despite the correction that we have seen already in the multiples, we still continue to remain far more negatively biased towards those.
Interesting. Last piece, Rakesh, is to try and get a sense from you. Therefore, if large cap IT is something you seem to be underweight on, would you go a little bit lower on the curve where the growth is a little bit better, but of course at slightly more premium valuations?
No, of course, and that is what we have done, Harsh, also.
Okay.
I think post the market fall that we have seen, we have added Coforge. Also, we have earlier been positive on Oracle Financial Services. That's been part of our portfolio for some period of time already and persistent as well. But I think given the multiple correction that we have seen in Coforge, which used to earlier maybe trade at between 1.8 to 2 time PEG, came down meaningfully. We saw an opportunity where growth profile for this business remains very, very strong, and the multiple that we are now paying for are far more reasonable, and therefore we have added that name. So yes, of course, I mean the thing that you talked about, moving out from large cap to some of the mid-sized companies where growth profiles remain strong and are available at reasonable multiple, is something that we have done.
Rakesh, thank you so much for this conversation. Plenty to take away.
Thank you so much for having me. Thanks.
Okay, no, thank you. Totally.